All right, let's dive in. Today, we're talking about a simple but really powerful idea. When it comes to money, your brain might actually be your own worst enemy. We're going to pull back the curtain on the hidden psychological forces that are secretly driving your financial decisions.
So let me ask you this. Have you ever felt this exact frustration? You sell a stock for a nice little gain, feeling pretty good about it, and then you just watch it skyrocket without you. Meanwhile, that other stock in your portfolio, the one that's sinking like a stone, you just can't bring yourself to sell it. It's one of the most common puzzles in investing. And the answer isn't in some financial textbook. It's actually hardwired right into our brains.
You see, for the longest time, all of economic theory was built on this idea of a perfectly rational investor. Someone who is always logical. But the reality, as the field of behavioral finance has shown us, is that we're emotional humans. And when money's on the line, our choices are often guided by these predictable and sometimes very costly mental shortcuts.
Okay, so first things first. Let's start by breaking down that old theory that really shaped modern finance, this myth of the perfectly rational investor.
The entire foundation of classical economics was this concept they called Homo economicus, which is basically a fancy term for a fictional, perfectly logical person who always makes decisions to maximize their own wealth, completely free from emotion. It was a nice, tidy model, for sure, but it had one huge problem. It's not how any of us actually behave in the real world.
And that brings us to the revolutionary idea that just completely turned this old model on its head. And it's a simple but incredibly profound insight. Our emotional reaction to gaining money versus losing money is fundamentally completely lopsided. This is prospect theory. It was developed by two psychologists, Daniel Kahneman and Amos Tversky, and it's pretty much the bedrock of all of behavioral finance. The key insight here is that we don't think about money in absolute final terms. Instead, we judge everything, our gains, our losses, from our starting point. And boy, do we feel them differently.
So just how different is our reaction? Well, research shows that the psychological sting of losing, say, $100 is roughly 2.5 times more powerful than the pleasure you get from gaining that same $100. To put it simply, losses just hurt more. Yeah, a lot more.
And look, this isn't just some weird quirk they found in a lab once. A massive global study recently tried to replicate these original experiments, and they found that the core ideas of prospect theory hold true about 90% of the time across all different kinds of cultures. This is a fundamental feature of how the human brain works. It's universal.
So what does this all mean in the real world? Well, it leads directly to something called the disposition effect, which, you guessed it, answers our very first question. We are so quick to sell our winning stocks because we want to lock in that nice, pleasant feeling of a gain. But we hold on to our losers. Why? Because selling would mean we have to make that painful loss real. And to avoid that pain, we just hang on, hoping and praying things will turn around.
But loss aversion is really just the tip of the iceberg. It's the foundation for a whole bunch of other mental shortcuts, or biases, that can get us into some serious financial trouble. These are basically ancient survival instincts that were great for us out on the savannah, but they can be an absolute disaster in the modern stock market. First up is the overconfidence bias. This is our tendency to think we're smarter and better informed than we really are. It gets fueled by this illusion of control. You know that feeling when you think you can somehow influence a random lottery ticket just by picking your numbers? That's it. And in investing, this bias makes people trade way, way too often.
And believe me, this has a huge real-world impact. Some foundational research in this area found that the most overconfident investors trade about 50% more than their peers. Just think about that for a second. All that extra buying and selling just racks up fees and commissions, and it almost always leads to worse results, not better ones.
All right, next up, the herding bias. We're social animals, right? We have this deep-seated instinct to follow the crowd, to do what everyone else is doing. In the world of finance, this is driven by a very powerful emotion, FOMO, the fear of missing out. When it seems like everyone is buying something, we feel this immense pressure to jump in too, which can create really dangerous market bubbles.
I mean, we saw a perfect example of this play out during the big Bitcoin run-up. As the price started to climb, the FOMO kicked into high gear, pulling in this massive flood of new buyers. The price just skyrocketed, up over 600%, and then, just as quickly, the herd reversed course, leading to a massive, painful crash. It's a classic story of crowd psychology in action.
Okay, and finally, let's talk about the anchoring bias. Basically, our brains have this weird habit of latching on to the very first piece of information we hear about something. For investors, that anchor is often the price they first paid for a stock, or maybe its all-time high price. And we then judge its current value based entirely on that old number, instead of its real fundamental worth today.
So these biases are pretty fascinating to talk about, right? But let's get down to brass tacks. What is the actual, real-world financial cost of all these very human errors?
And honestly, the data here is pretty shocking. Just that simple act of selling your winners too soon and holding your losers too long, that disposition effect we talked about, that alone can cost you up to 3% in returns every single year. Then you add in the excessive trading for being overconfident, and you could be losing another 2% on top of that. These are not small numbers, especially when they compound over time.
So, where does this all leave us? It means we really need to start looking at ourselves and our money through a completely new lens. We have to accept that these biases aren't bugs in our mental software, they are built-in features of how our minds work.
The most crucial takeaway here is that these biases aren't random mistakes. They are systematic. They are replicable. They show up again and again in study after study. They're a deep and predictable part of human nature. This is the rule, people, not the exception.
And just how widespread is this stuff? Well, some estimates suggest that these cognitive biases have a real, measurable impact on somewhere between 70 and 90% of all individual investor portfolios. Basically, that means it's almost a guarantee that this is affecting you and me.
Which leaves us with one final and I think really important thought. The first step to dealing with this is awareness. And now you know. You know your brain is literally hardwired to make financial mistakes. So the real question, the one I want to leave you with, is this. What are you going to do about it?